right, good morning, everybody. Let's go around the room. I'm Andy Schaefer, representing Commissioner Kelly.
Barry Dennis, SIS.
Joe Strong, PBA.
Chris McGrath, PBA.
Vincent Valley, SBA.
Roy Richter, CEA, and very happy for June 30th. I know the controller.
Daniel Brown, LBA.
Bill McNeely, DEA.
Bob North, Actuary.
Yvonne Nelson, Controller's Office.
Barry Miller, Controller's Office.
Martin Gans, Controller's Office.
Larry Schloss, Controller's Office.
Thad McTee, Controller's Office.
Janice Emery, Commissioner of Finance, and I also have the proxy for the mayor today.
Bob Sansky-Stead, Pension Fund. Kevin Holloran, Pension Fund.
Tiffany Cole, Controller's Office. Rhonda Kevin Arrow, Pension Fund.
Okay, let's turn it over to Larry.
Larry.
Thank you. I had bronchitis last week. I can't hear out of this ear, so I can only take Roy's comments. So if you have some comments, you have to speak up if you're on the right of them. Similarly, if I start muttering, say speak up. It's okay, because again, I get very, very quiet because of how I hear it. In any event, what did he say? Roy was correct. If we annualize the last day of June, we're fully funded and all gone. That would be. So let's look at the monthly report. Everybody have a monthly report? I'll go pretty fast because the month of May was a bad month, but it got made up in June. So it was a happy ending. I won't walk you through the economic slides. I'll just give you a quick summary of what's going on. I know you all read the papers. Basically, the U.S. economy is slowing, as witnessed by 80,000 jobs created last month, which is just not enough to get the machine going. So 8.2% unemployment, we're stuck. In addition, part of the stuckness is the fact that we have these fish tax reductions that are rolling off at the end of the year. The fact that there's tax regime uncertainty means that people are not sure how to make their investments, companies and people. So uncertainty means nothing happens. Nothing happens like you don't build a new plant, you don't hire new people. Then when you overlay that with the election coming, so you don't know if it's Republicans, Democrats, it's very easy to sort of do nothing. And doing nothing when you come in a recession gets you back into a recession. In addition, we have the continuing saga of what's going on in Europe with the Euro and the EU. That's a 2 or 3 year thing. It's just not a short-term affair, even though it has fits and starts. So Greece was the problem last year, fits and starts. Then Spain comes along, Spain's bigger, then Italy's behind it. Germany funds the whole thing. It's quite complicated. So it leads to us having uncertainty, and that leading to choppiness on top of the uncertainty, and just adds to more uncertainty. In addition to the uncertainty, there's the real economic backdrop of recession coming in Europe. It's already in a few countries, like Spain with 25% unemployment, Italy, Greece. So that's spreading, even though, again, you'll see some numbers every now and then that says it's okay. It's not okay. So what happened in May, we have the May numbers, there was one of these fits of a problem. The fit of the problem in May was, it started in April with the election of a new French president, who was socialist as opposed to the other guys. So he said, hey, I don't like austerity, I like growth. So all of a sudden, the number 2 partner with Germany gets a new player in the game. That caused anxiety. At the same time, you had the socialists come from out of nowhere in Greece saying, hey, we don't care about the deal we the government cut with you in January, we want to renegotiate the whole thing. So that led to just a mess of the markets in May, which I'll show you in a second. And then the people responsible adults got in the room and said we need to fix it, and it got fixed literally the last day of our fiscal year, or the night of the last day of our fiscal year. So stock markets roared on June 30, and that gets to our end of the fiscal year. So it was down, and then roared back up at the very, very end, and the day we care about is June 30. While all that's going on, we do have you have China, which is the second biggest economy yet. but clearly one that's growing the fastest, having its own bubble with its own problems, and not immune. If you think about Chinese manufacturing, they make stuff, it says made in China on the back, for the U.S. and Europe. So to the extent that we're slowing down, it hits them too. And they have their own housing bubble and issues. Although they don't have to have 17 countries get together or two parties to get together to make change, they sit in the room and make change. So change there happens nice and fast. So they've cut interest rates twice in the last month or so to kind of keep their economy going. That's about where we find ourselves today. So we're kind of, again, June 30 was a good day because of announcements coming out of the EU. The problem with every announcement that comes out is it lasts about a day or two, and then everyone says, well, the devil's in the details, there's no details, and then it comes back down. So now we're going to have back down periods, and it's the summer, the vacations in August, so I assume we'll have choppiness to flatness, and then we'll pick it all up in the fall, and who knows, same kind of thing, choppiness, action, inaction, presidential election, wheels fall off every now and then of one or two countries. So very difficult to actually make money when all this is going on, because whatever you think the plan is, you have to be very nimble, and we're not very nimble because we're big, but hopefully our managers are nimble. So if you were to jump to page 41. Page 41 is one of those. Page 41 is one of those bad months, right? So if you look at the top cluster of numbers, it's U.S. stock market down 6% basically. This was with the uncertainty as to what was going to happen in the Greek elections. So the U.S. stock market down 6%. Europe and IFA and emerging markets goes down 10-11%. So all the equity markets basically collapse. If you go down, look at the double B, single B, that's the high yield market, backs up 1%, and money flows into the treasury markets. So that's a bad month. There's nowhere to hide. Our portfolio is about 65% equities. Back out real estate and private equity, 55% or so, public, plus or minus, and you can see -6 and -10, so we're going to have some bad numbers. What I'm handing out, on the other hand, not to depress you, is June, which is the good month, which you don't have the numbers for. But if you see what happened in June, again, the top block on the left, U.S. equity markets were up about 4%. IFA was up 7, emerging markets up 4, high yield market up 2%, and a little bit of give up in the treasury market. So you actually have to add these two together to really figure out, again, since we last met, to look at April numbers. So you're down, and then you're right back up. So if you go to the page 42, you'll see that in the bad month, on the far left-hand column, we lost about 4.3%, which brought our year-to-date, which is the third column, to minus about 2%. So here it is, the second week of July. We don't have the numbers yet. I'm confident we're back in positive territory based on the numbers I handed out on the markets. I can't quite tell you what the bottom line number is. Sorry, I can't quite tell you what the bottom line number is because we're trying to figure it out. But again, if you just look at the pages I hand out on the markets for June, do some back of the envelope, you get yourself past this minus 1.89% for the 11 months number into positive territory. So again, I'm pretty confident we're going to end up at the end of the fiscal year positive territory. So if you go back just for some historical perspective to page 33. You can see how he's bounced around month to month in this fiscal year. So he came into it at $24.6 billion. End of May, we were down a little at $24.5 billion. I'd like to think we'll get north of about $25 billion at the end of the year. So the 25 is going to compare to the 24.6 billion. So again, I'd like to hope that, I'm pretty sure it'll be up. I can't tell you what the whole number is. Since we're starting coming into it at 24 and a half, I'd like to hope we get north of 25. Next board meeting, I'll tell you the exact number after we get it. So if you look on page 34, we can get it up to 25. That'll be the highest the police pension fund ever closed its fiscal year at, and that'll be good news. If I go to page 37, to show you the asset allocation at the end of May, I'll give you a couple of additions to it. We're pretty much on our allocation when you cut through it all. We were 0.8% over in U.S. equities, and during the month of June, we sold 0.8%, so we're perfectly allocated. Not perfectly. We're right on the asset allocation, the adjusted asset allocation for U.S. equities. We took those proceeds and put it in the Core Plus 5, which is dark blue. So again, we're on top of the asset allocation in Core Plus 5. We funded a hedge fund that we all approved last time, so about 50% of the way into our hedge fund program. The biggest under-allocation is opportunistic fixed income, which is the pinkish color, which again, we've now executed contracts with a number of the managers, so that should be ramping up as they draw the capital down. We had about 2.6% cash on hand because we're trying to do some asset allocation and fund some of the programs we've approved, which is about what we're under in tips. So again, if you add the two together, we're pretty much ending the year spot on the adjusted asset allocation policy rates. So with that, I guess the takeaway is I think we're up a little bit for the end of the fiscal year, probably with a 25-ish handle on it, and we're pretty much on our asset allocation. Any questions? Okay. Barry? You're next on this agenda. SIS attribution.
Okay, this is a look at the longer-term performance, sort of at the bigger levels, so at the total fund level and at the individual asset class levels. The overall report card is that this is pretty good. We're looking at periods ended March 31st, 2012. The one-year period from 11 to 12 is not good, and it's hurt some longer-term results, but the longer-term results still stand up. And I'll get into a number of reasons as I go through this. Let's start on page 69 in your book, and these are just some observations from a big picture point of view, and I'm only going to hit on three of them. The first bullet, your longer-term results, the 5 and 10-year cumulative results, put you at the top third of a universe of public pension funds that have at least $10 billion in assets. And that universe at its peak has in the high 30s. So it's a decent background for comparison. The benchmark has a private equity component that is 500 over the public markets, and we think that's a little high. I think most are at 300. So I would just say if we took that down to 300, we would reduce our benchmark returns by about 15 basis points. So things would look just a little bit better by doing that. And then when we look at that last year, that hurt results, in the U.S. equity class, before the year began, we had decided to overweight small cap and mid cap and underweight large cap, and that didn't work out in that year. But these were based on long-term decisions, long-term performances, and I believe we have to take a while for that to work out. We watch it very closely. And what's happening is when risk is on, the small cap bet works, and when risk is off, it performs very poorly. But it hasn't been a consistent underperformance. It's been off and on, depending on if the market's going up or down. Then I'll drop to the second last point. And when we look at the individual asset classes, your tracking error or deviation from the index is very low in all of the asset classes. Now, for U.S. equities, that's because you have a lot in the index. And for fixed income, you don't really have any passive, but you have very tight guidelines on durations and sector exposures that keep you very close to the index. And for international, you do have a little bit higher than the average bear in terms of passive, but those tracking errors are not in the bottom decile. They tend to be around the 75th percentile. So I think the message is, because of your very strict risk controls, that you're not going to be at the top of the sample or the bottom of the sample when you look at a period of at least 3 years. Let's go ahead to page 70. And this is just looking at the total fund. I think if you look at 70 and 71 at the same time, you have a policy index, which is index fund performance at your long-term policy weights. This isn't the adjusted policy. This is the target allocation. But then we can do another thing, and what we do is we take index fund performance and weight it by your actual allocations. Now, the difference between those two will tell you if your deviations from your policy have hurt or helped. And on page 71, if you compare the policy index to the allocation index is consistently higher, which says whether it's luck or skill, those deviations have actually added value. I know that's been a controversial thing, and some of that is just because we're taking time to build up allocations in certain asset classes.
And Mary, where exactly is that value added coming from? Do you know which particular asset class? I asked where exactly the value added was coming from versus the actual allocation versus policy, if we know what asset class.
I would say the biggest contributor to that is that the buildup of the real estate to its target has been slow, and that's been good. Because
So, underweight to real estate
has been good.
Helped.
Yeah, especially in the periods from 07 to 09, that 3-year period. And that shows up when we look at the 3-year rolling charts as well. The other observation I have is when returns are really good, say above 10%, this fund does very well relative to peers. Where it suffered was in the dot-com crash. So the 3-year periods encompassing when the tech stocks fell apart, this fund did very poorly. And then the other period on a relative to other funds basis where this fund did very well was in the 3-year periods that encompassed the global financial crisis. And I think the real estate comment really comes through in those periods, because your peers have had a lot more in real estate, but the same type of real estate that you have, basically overweighted to non-core stuff and highly leveraged. So on page 71, you can see the 5 and 10-year ranks at the top third. Again, last year, an 80 percentile ranking and well below your policy index.
I assume that since it's a March 31 year?
Yeah.
Since the markets went up in June quarter?
Probably improved,
I
yeah.
think we'll end up better. We should be better than that for the fiscal year.
Okay, I think page 72 is probably the most important page. And this is looking at rolling 3-year periods, covering about 12 years. So if you go to the right at the beginning of the period, from 01 to 03, this is the dot-com crash. And the ranks were miserable. Very equity-centric portfolio at the time relatively undiversified compared to what it is today. And then we see some very solid improvement in all 3-year rolling periods following that. If you start out in 2003, every 3-year rolling period is top half. I think this is probably the most important, and this is the one that would lead me to make the conclusion that this fund has been run well.
Barry, before drawing that conclusion, with respect to this universe of funds over $10 billion, what is the average asset allocation within those, and how does it compare? Because historically, as you know, this fund has always been U.S. domestic equity centric and fairly highly equity oriented, and therefore we rode the markets up and down, and that could explain most of the rankings. But is there any material difference at this point in the allocations of the sample versus our fund?
Well, you have your fixed income allocation is pretty even with everybody else. How the rest of it is distributed is a little bit different, but it's coming a lot closer. 10 or 12 years ago, it was very different because it was all basically equities. Anything that wasn't fixed income was public stocks. But now you're getting to the point where you are becoming closer due to your allocations to the non-public fund type, non-public security type asset classes. However, you know, while you're coming closer, your peers are going further and further. So just playing catch-up is difficult because they're also moving ahead. So I would say you're a little bit behind in terms of your actual dollars in the ground or percent of portfolio in the ground in things like real estate, to some extent private equity, and hedge funds. But you're catching up.
Right, but of course, you're referring to catching up with respect to the averages, which isn't necessarily the objective of the fund.
Correct. I was just answering your question, Bob. Okay, let's jump ahead to the U.S. equity analysis on page 75. This is probably the least attractive section in the book. And it looks that way primarily because of the last year, where you underperformed your benchmark by 180 basis points. Now, I can parse that 180 basis point differential into two areas. Number one is the overweight to the small and mid-cap, underweight to the large cap. That cost 110 basis points. And then combined manager underperformance is sort of the fudge factor there, and that comes out to 70. As I said, these were based on long-term decisions. There's no reason that I can see to unwind that at this point. If we look at the rolling 3-year periods, they're generally favorable with the exception of what we saw, the 1 3-year period that's impacted by the last year. I will tell you that ranks don't mean a lot because your passive content at the beginning of this period was 80%, and it's gone down to around 60% today, 65%, but that's high relative to these peers. So what's more important is comparing your returns to the benchmark rather than your peers, because you're very different than your peers. Although that gives you some good information looking at what the peers are doing as well.
Yeah, Barry, just on bullet number 4, what exactly were you trying to say there?
Oh, I made a mistake. The second word, index, should say peer.
Peer,
So
okay.
due to low active exposures, index comparisons are more meaningful than peer comparisons.
Thank you.
Thank you. Thank you for pointing that out. let's see, we go to page 76, and the cumulative ranks are all sub-median. Again, the 3-year rolling charts, which are on page 77, tend to be the most instructive. And here, if you compare to the index, which I just got done saying is an important comparison, you outperform your benchmark in 6 of the 10 rolling 3-year periods. You underperform in 2, and you match in 2. Not bad.
And this is gross of fee or net of fee?
This is all gross of fee, but so is the universe. And then on page 79, when we look at how we manage the non-index risk, this is the information ratio. So it's the difference between your return and the index return divided by the standard deviation of that difference. These ranks, well, first of all, the numbers are basically positive, so you're getting positive risk management out of the portfolio. And they're basically above median with a few exceptions, the most glaring being the last 3-year period, which I've already highlighted as being a bad one.
So Barry, can I ask a question?
Certainly.
With regard to an information ratio expectation, if we're going to employ active management, what should we expect, what should our information ratio be in order for us to want to continue to use active management?
Well, I think a good active manager has an information ratio of 0.3. That pretty much gets you to the top quartile break. When you put a bunch of 0.3s together, you get a total fund information ratio, again, depending on how much active content you have, but if you were all active and you had all 0.3s, your total fund information ratio would approach 0.75. Okay. Again, that's if you're all active.
Right. So if we look just at our active, do we know what our information ratio is just for active?
Well, I don't, but I can back into it. If you look at the information ratios, say on page 79, and consider that over that period we probably averaged, let's call it 30% active, right? Okay. You might multiply those numbers by 3. That would make sense to me. Now things get better for the next 2 asset classes, although that wasn't bad. Fixed income. First of all, when we started doing this, we realized we didn't have a composite of all your fixed income accounts. Your composites and performance are being created by Mellon Bank, and they just never did that. So we went back and asked them to do that. I got those numbers after this report was distributed, so I'll just give you a few numbers a little bit later. So
I also want to clarify, they do have a composite for overall fixed income, but that includes cash, which we want to exclude from that.
I think we've got it right. But so here what we're looking at is just the Core Plus 5 program, the structured program. And what we find is, it's consistently above median when you look at the 3-year rolling periods. It suffered when the global financial crisis was going on, but it rebounded spectacularly coming out of it. Those are probably the 3 observations that I would take away from the analysis. But like U.S. equities, your tracking errors are falling in the bottom decile, so very, very risk controlled. If we look at page 82, You see your ranks vary, but over the 5 and 10 year, they tend to cluster around the median. They are very close to the benchmark on a 5 and 10 year basis, right on the benchmark. Now, I have a couple numbers that include all the fixed income classes, so we would add into structured the high yield, the ETI, the converts, the opportunistic fixed income. Did I get them all, Martin?
Tips.
And tips. 3-year number, 10.8. Puts you at the top of the heap. 10-year number, 6.9. Gets you well above median. So when you put all those other fixed income sectors in, this has been a star performer. If we look at page 83, you find that the 3-year ranks seldomly fall below median. The most recent period being the only example, I guess there's a 51 in there. And maybe I'm just a trivia buff or something, but what I find the most amazing in looking at this page, if you look at the 4th column to the right, the 3 years ended in 2009. You have your worst year versus the benchmark, 100 basis points under. But it's your second best rank out of the 10 3-year periods. Tells you how different your fixed income, at least the core plus 5 is different from the universe out there.
But Barry, isn't that really part of the history of the prior chart as well, showing the better returns, and that we've just gone through a decade of declining interest rates with an average duration portfolio slightly greater than the duration of the benchmarks and the median portfolios?
Yes, that has something to do with it.
That's part of it, but another big part of it is the fact that it's a structured program where we have specialist managers, where most other institutional investors use core managers, which heavily overweight one sector over another. And we found that the structured nature of the program has helped produce more consistent returns and predictable returns. And that helps explain some of the numbers.
But I'll place a very good on the fixed income, and perhaps we're saving the best for last with the international portfolio, international equities. And we look at this 2 different ways. First of all, we look at just your developed managers, and we compare them versus EFA, and then a universe that includes emerging market exposure. So on these first couple pages, the peer group comparison isn't that meaningful. The benchmark is. And then in the last few pages of this section, we include your emerging manager exposure, emerging market exposure, but you only have like 7 years of that where you actually built up a significant weight in emerging markets. So I'm on page 87 now, the first bullet. When you just look at your developed versus EFA, they're producing 1 to 2% of excess return consistently, and that's very good. And I would say when I started working for the police, which is about 14 years ago now, the international portfolio, and maybe Martin remembers this as well, he was probably the only one in this room that was around then besides me, it was the problem child of the portfolio. And if we look at the last 7 years, it's been very, very good. Let's look at page 88, and we see consistent outperformance versus the EFA benchmark. These again just being the developed managers, although the ranks tend to come and go, depending on how the universe, which holds emerging markets exposure, performs. Now, I like these 3-year rolling charts on page 89, and the most, I guess, happy statistic you see in this is the last 7 years. the last 7 3-year rolling periods, so that's a 10-year period, every single one of those periods beats the benchmark. On page, where am I? Page 92, we begin adding the emerging market exposure to the developed market exposure and getting an all-international composite, comparing it to the ACWI ex-US benchmark, and again to the median. And so now the peer comparisons are relevant because it's apples to apples, and although our advantage over the index goes away, our ranks soar, basically to the top third. And if we look at the rolling 3 years periods on page 93, we only have 5 of them, but they're all above median. And we see overperformance versus the benchmark at the beginning and underperformance more recently. So let me just stop here unless there's questions. I would say it's a pretty good report card. I think, we have to keep working to fill out our asset allocation as Bob suggested. There's work to be done to get there. And asset class by asset class is pretty darn good in 2 out of the 3, and I would call about average in the U.S. equity area when you look at the rolling 3-year period results. So pretty good.
This was really helpful. Thank you.
You're welcome.
How often are we doing this going forward?
How about once a year?
No, really, we should. Otherwise it's just too short term, right?
Once a year sounds good.
Sounds
It'd be good
good.
if we did it after we had the full year results. It's a sort of, I have a hard time with something take on March, 12 months.
Right.
I can't quite relate to the numbers. So maybe we do it every fall, because we look every...
So for the fiscal year?
Yeah, for fiscal,
Okay.
so everything's fiscal year, because everyone looks at fiscal year numbers, and that's right we're doing.
Very good.
Okay, thanks. Any other questions?
Just one question, Barry, just to try and tie your report back to the material that's received monthly. You show on the international, for example, that the last 10 years have been very positive relative to the benchmark, and yet the numbers here, unless I'm reading them wrong, from Bank of New York seem to suggest the opposite. What am I missing, or what, am I just reading the wrong line? I'm looking on page 50 in the monthly performance review under total developed markets.
What page you on, Bob?
Page 50, total developed markets. And I thought that was pretty much our EFA-like performance for the last many years.
I'll have to look into that. But, we get our numbers right from Mellon, so
Should be the same number.
it should be the same.
Yeah, in theory, I thought they tie together pretty closely, but they seem to be giving a slightly different message here.
I'll look into it. I'll report back.
And the one other comment I'd make in terms of overall benchmarking is the continual problem of what should the objective of the fund be. Should it be the indices plus something for active managers across the board, like is done with private equity, for example, gross or net of expenses? and or whether everything should be reported without expenses where they aren't readily available. And with just the index level, and you build your own estimate of an alpha into it. It just seems to me that there's kind of a mix and a match issue within this that might be worthy of a larger discussion at some point. Not today. Just as to what is the best way to address the actives and whether on a risk-adjusted basis active management is adding real value to the fund.
We capture some of that, right, with this information ratio analysis?
Well, the information ratios, let's say I find, no offense, Barry, I find the information ratio analysis somewhat lacking. How do I want to say this? Well, I believe what you've reported is across the board for the portfolio as a whole within an asset class. And I do think the numbers would come out quite a bit differently looking at it broken between passive and active. And also on your charts, if you look at the information ratios over long periods compounded, they appear to be significantly different than the 3-year rollings on average that you showed. It's like any other tool. It has value and it has limitations. And so it's a much bigger discussion, but I don't take what is there verbatim as automatically meaning that it's good. Because there is no adjustment for expenses, there is no adjustment for risk. Although, yeah, I know we got the standard deviation reflecting something in there, but we don't have all the backup as to the quality of those calculations either. So call me just, I'm sorry, I'm acting as my usual role as the designated skeptic. But yes, hopefully we have all positive information ratios for all of our active managers that far exceed the risk and the cost of doing it.
Any other questions?
Am I supposed to respond to that?
I thought it was a filibuster.
I think we should review all the benchmarks as part of the process.
Yeah, I guess before the filibuster, that was really my major point, is that there's a lot to this, and this is a very valuable exercise for the board, but it also does lead to some good questions that may result in a better benchmarking and expectation setting, not just for the portfolio, but down to the individual manager level.
Thanks, Bob. Okay. The last item on the public agenda is an update on some procurement issues that we'd like to talk about. I go with that. Chad, why don't you run down there?
What's that?
Why don't you run down there?
Well, because I figured Tony was going to do his piece down there, we do it together. Does that make sense?
Sure.
Steve, you want to come in? So if I could direct the board's attention to page 97 of the book. There's a PowerPoint presentation entitled Proposed Amendment to PPD Negotiated Acquisition Rule Presentation. I have with me today Anthony Delilio, who is an attorney in our office, and also the controller's ACO, which is the Chief Agency Contracting Officer, which I guess in layman terms makes him the procurement expert in our office. And also Steve Cushman, who is the head of the law department section.
Contracts and real estate.
So, as the board knows, we've been dealing with many areas of the PPP rules in an attempt to try to make the rules more user-friendly and give the board an opportunity to navigate the rules so that we can continue to select managers that are appropriate for the board within the context of the city's procurement rules. So what Tony and Steve are going to go through today is a change that our office and the mayor's folks are pursuing with the Procurement Policy Board, which is a body made up of 5 representatives, 3 from the mayor and 2 from the controller. And we're hopeful that with these 2 sort of what I'll call tweaks to the existing rules, 2 amendments, that we'll be able to give the board more options in the future in selecting managers and retaining managers. So with that, I'll turn it over to Tony and Steve.
Thank you, Thad. Good morning, everyone. As Thad just pointed out, we're here just to update you on what we propose for to be amendments to the city's procurement rules concerning negotiated acquisition, which is a procurement method under the rules that allows a city agency or anyone subject to the rules to negotiate directly with a vendor without issuing a competitive solicitation. It is allowed under very limited circumstances when there is a time-sensitive, compelling need or a limited pool of providers, and where using that a typical competitive method would not be feasible. The procurement rules currently prohibit the use of negotiated acquisition to procure investment managers, except in limited circumstances with respect to the Emerging Manager Program, which I'll talk about in a second. We're working with the PPB to address this anomaly, to allow the use of negotiated acquisition in the same manner and the same circumstances as the method is authorized for other types of services. The amendment will provide the investment boards with, as Thad said, an additional procurement tool to use when it's appropriate and when the board deems it's appropriate. One of the major benefits is that it will allow the board to extend contracts for existing managers who have good performance and whose contracts would otherwise expire. The other part of...
Can I explain what that really means? So what's happened a couple of times is we've had a manager, we like them, they're at the end of their allowable extensions, and their contract expires. So all of a sudden we lose a good manager. The only way out of that is for us to start a big RFP process for that entire asset class's managers. So it's literally like the tail wagging the proverbial dog. So what we're trying to do is say, hey, wait a minute, if this is going to happen, what we would propose to do is go to the boards and say, look, XYZ manager is expiring. We like them. We want you to approve us extending their contract for like a year or 2, whatever the case may be, just so that we have an orderly, if you will, ramp to have a regular way RFP. Otherwise, again, what happens is we just lose good managers for no particular reason other than they're out of sync with the rest of their asset class. So it tends to be the older managers because now we have pools, so we can at least substitute people. But in the old days, there was no pool. We actually have run out of managers, or they might be the last surviving manager in an asset class. And the way it's set up is we just have to lose. So this is really just. It's a tweak to the existing rules so that we don't have to tail wag the dog. We can plan the business better. And it should be non-controversial, and the controller's office won't extend anyone's contract without us first coming to the board and saying, here's what's going on. We want to do this. We want your approval to do this. Is that correctly, Dad?
I think so, yes.
So, Larry,
That's one part of it.
can I ask a question then?
Yeah.
So let's say we have a manager that we need to replace quickly. So there's a limited time-compelling need. Are you wanting to use negotiated acquisitions in that case? Or are you looking at using the pilot procurement process for that?
This has nothing to do with the pilot procurement process. This is a case-by-case thing. The negotiated acquisition, well, I should defer to you.
So I would tell you, Janice, that...
Not you. I should defer to someone that actually lives the negotiated acquisition process for life as opposed to me.
Well, the rule has basically 3 possible standards. One is the extension of an existing contract, and that's predominantly what we've been talking about so far. The other 2 are if you need to get a new contractor, not to extend an existing, but to pick a new contractor, you can do it without the full-blown RFP process if there's a compelling need in a time-sensitive situation, or if you determine that there's a limited number of suppliers, a limited number of possible contractors. And so the amendment, as far as I understand it at the moment, is structured to provide for all three. And I guess Janice's question is that what you're looking for, to amend the rule to give all three instances, or just the extension of the existing contracts?
And the answer is yes, it is. The proposed amendment is to avail the boards and the controller's office to avail itself of the entire procurement method that everybody else has available to them. It doesn't mean the board has to do that. It would be up to the board as to whether they would want to use the negotiate acquisition method in order to procure an investment manager under the limited circumstances that the negotiate acquisition method allows you to. Doesn't mean you have to, but it would give you that option if all those circumstances were met.
So do you have a process proposed for negotiated acquisitions that you're going to explain to us?
So, Tony, if I may, I think, Janice, in terms of Larry's example of extending a manager where they don't have extensions, we'd come to the board and say that we would like to extend the manager and then meet the performance guidelines. I think Larry made a good point earlier in his presentation where he mentioned that in kind of your example, we now have the pool. So if you had a manager, we have a pool now where we didn't have those previously. So it's more likely that we would use the pool process. And thirdly, I think Tony also raises a good point that what we're really doing here is bringing a level playing field to the pension boards. Right now, negotiated acquisitions allowed throughout the city, and we don't really have that ability. So we're saying we want to have that ability. So it's up to the board ultimately how we use it. But I think in your specific example, we would most likely avail ourselves of the pool process.
So if I just to clarify, so the standard of there's a compelling need in a time-sensitive situation. Something happens, you have too great a concentration of assets in one contractor or something, and you're looking to move to get a new contractor in place to diversify, something like that. The rule itself, that if it were allowed for investment managers, that could be a compelling time-sensitive situation. The rule itself doesn't really have any required process. It just requires a public notice, and you sort of pick whatever process that you want. So it would then, if the rule were opened up, it would then fall to BAM or to the board to determine what that process was. And I think that's what Janice's question was more to, is if you open up the rule to that in that situation, do you have a plan now for what that process would look like?
That is, and thank you for clearly stating what my question was. I guess my concern is that if we're going to open this up to a negotiated acquisition process, then what is that process? I think we would, as a board, need to understand what the proposed negotiated acquisition process will be before we can say, yes, this is a great idea, or, we need more information. So I think in concept the idea is a good one. It's just that I think at this point I don't actually understand what you're proposing in terms of a process to say, I think we should go forward with it.
I can tell you in equities, we would do what we always do when we come with a recommendation to the board, which is if we wanted to extend the contract with a large cap manager, as an example. I'm sorry, see. If we wanted to extend a contract with a large cap equity manager, as an example, we'd come, we'd show you how they've done for us, the same slides that I've done here many times before, about why it makes sense to continue on with that manager, show you their performance net of fees, show you how they compare with other managers in the universe, and make that recommendation.
And that's pretty straightforward.
Yeah.
I guess that's not my concern. My concern is opening it up to these other two methods where there's a limited pool or where there's a time-compelling need. And it seems like there would need to be some process for those other two cases.
Well, let's think about those two cases for a second. So there's a compelling need. let's assume that we don't have a pool. So given the asset classes we have, I would think a compelling need might be if one of our two index providers' computer blew up and there's a virus in the software. Okay? So all of a sudden, 20% of our portfolio is out of control. Okay? There's only 4 providers that we can use, having done this 2 years ago, right? So there's only 4 providers, and one of them whose computer just blew up. You've got 3 guys, the only 3 people you can go to. Put an RFP in place, because this is the way the process works. You put an RFP in place. Well, first we go to the boards, explain to the boards. The boards would say, we'll do something. We say, great, we're going to go as fast as we can, talk to the only 3 providers that there are out there, have them do the usual RFP stuff, which is information, proposals, and come back to you as soon as possible because we have to fix this problem. Come back, rate everybody the way we would a normal manager, and come back and try to select them as fast as possible. That's the process.
Okay.
It's the same RFP process we have because, again, there's only one RFP process that exists right now for money managers. Now, we have this pilot program, but that's a pilot program. That may or may not happen. This is trying to fix something different than the pilot program. This is trying to deal with, you need to be expedient. How do you be expedient? The answer is, again, the way the law works out now for negotiated acquisition. If there's a limited number of managers, and you have to be expedient, go to it. So that's what we do.
So would it be reasonable to say that we're almost over halfway through the pilot procurement process today? And I know this is a different topic. And you're coming up with some standardization in terms of what your process is and what you're showing to the board as a result of being over halfway through that process.
So I would tell you they're 2 separate things. I think that what's important here is that this is sort of what I would tell you, a clean-up, a tweak that allows the boards to have the flexibility consistent with what is done throughout the city. The innovative procurement process is completely on a separate track, so these 2 are not related. Or put another way, if we weren't doing the innovative procurement process, I would tell you that in our efforts to give the board more opportunity, we'd come here anyway with this cleanup because it's an appropriate cleanup. So they're not related.
So what my point was that SEMA is telling me that what we would see as a result of this new negotiated acquisition process is pretty much what we're seeing today that's coming out of the pilot procurement process. Is that a fair statement, that we'd be seeing about the same, the board would be seeing the same type of information from the consultant and from BAM as we're seeing today for the pilot procurement process?
Well, let's be clear. The pilot procurement process ends in October. Just ends. So between October and whenever we figure out how to get it approved into law, we have no other process than the existing RFP. And you should take comfort in the fact that however we procure managers, whatever we show the boards, however we involve the consultants, be the exact same way in the same standard of care that we do every procurement. But I can tell you for sure that there are contracts between now and when we hopefully get the pilot program officially done and on the books. Contract expirations will happen, and we'll lose managers. So the result of that is, why are we going to sit around and wait for men to lose managers? Let's fix this problem. This is a small but important problem. It doesn't make any sense to have on the end of the 9th year, you have to fire a manager. It makes no sense at all.
And I agree. I think my only point is that what we need to see as a board is what the process, what the negotiated acquisition process will be, and what the output of that process will be, that we will see in order for us to make a decision-making.
The output is identical.
Well, that's what I'm getting at.
It is identical.
So today, I think we're struggling to get some sort of a standardization in terms of what we're seeing for recommendations for managers from SIS and from BAM. So what I'm asking as part of this, which I think a very good move on your part, is that we do get that you would work with the consultants to get some standardization in terms of the recommendations that the board sees going forward. And once I think we get that standardization where we know we're going to see the same level of information from SIS and from BAM every time there's a manager recommendation, I think we'll have that comfort level that there has been a thorough due diligence process, which we know is happening. So really all I'm asking for is for some standardization of output.
Janice, I think you're in a completely different field than the topic we're talking about.
If I may?
Please.
I guess, Janice, I'm a little confused because you talk about this struggling of standardization. I didn't know that we were struggling on the standardization. I think you're trying to interject a topic here that has not been a board discussion in terms of this whole idea of struggling for standardization. I'm confused. I go to the meetings with you, and I don't know where that's coming from. What I think the important part here is that Tony and Steve are here to say the rest of the city can use this negotiated acquisition. We want to give you that rule change so that you can do it. How the board chooses to use that is our business. But right now, we don't have that ability. So I think you're making this more complicated than it needs to be because you have this notion that we're struggling for standardization. I would tell you not true. If the full board wants to have that conversation, that's a great conversation for us to have. But I think the takeaway for the board today should really be twofold. One, we want the same ability that everybody else has. How the board uses that or wants to go about that is their business. So I think you're kind of interjecting something here that in my mind doesn't exist, but if the board wants to have that conversation, I think that's a separate conversation. But I think what we're trying to say today is we as a board want the same ability in the negotiated acquisition piece that everybody else has. It's really fairly simple.
If I could just clarify, I'm actually not here to support the rule or oppose it. I'm only here to understand what it is that you're proposing and to answer questions and explain it.
So do we want to go to the second part of the rule, Tony? Can that be helpful?
Shall we? Okay. The second part of the rule pertains to the Emerging Manager Program. And the proposed amendments are sought to clarify and streamline aspects of the current rule as it applies to that program in order to increase the efficiency and enforcement of the program while maintaining the appropriate controls that are in place so that sub-managers could graduate into direct contracts. These changes make the PPP rules consistent with the original intent of the Emerging Manager Program and with the Retirement Systems Boards of Trustees guidelines to enable sub-managers to enter into direct contracts with the controller on behalf of the systems once their assets under management grow too large to justify the extra expense of managing assets through a manager-of-manager structure. So the clear benefit here is to in clarifying the rules to graduate the sub-managers to direct contracts. Right now, the only way to do that is to actually terminate or have expired the manager-of-manager contract, which is not really the intent of the program. The way the graduation program should work is that once the sub-manager is doing a good job and has assets under management above a certain level, which the boards will set, they should be able to graduate into a direct contract. Right now, the way the rule is written, you can't do that unless the manager-of-managers or some contract is terminated or has otherwise expired. So you can't do it during the course of however long that manager-of-manager contract is. So this is a really way to clarify the rules so you can actually use it.
This is something we talked about a year ago, I think, about how the whole manager-manager program is to incubate new managers when they get big enough to give them a contract directly. The problem is there's nothing in the procurement rules that allow you to give them a contract. So he just has to stay there as a manager in the incubator, but he's all grown up and ready to go. Again, the only way to give him a contract is through an RFP process. So we want to just, again, amend the rules so we say, look, if it actually works, we have a good manager, we want to give him money directly outside the manager and avoid their fees, we can do that. It's about, we were all pretty surprised, at least I was surprised, that the program didn't work like this in the first place, because this is what it's designed to do, incubate and then give money directly to the manager. But the procurement rules don't let you do that. So this is to fix that.
These sound like great ideas. I'm surprised we didn't do it in the past.
We're surprised too.
So, questions? If anybody has no questions, we're going to continue to try to achieve these rule changes. And as Larry indicated and others, should we be successful in changing the rule, and we'll certainly come to the board before we would avail ourselves of any of these, what I would call tweaks. So, thank you for your time today, and look forward to working with you on this.
Okay. That ends the controller's agenda for the public session.
All right, we need a motion to exit the public session. Do we have a motion?
Can I ask a question?
Oh, sure, I'm sorry.
So we have a policy discussion on the agenda with regard,
I'm sorry, we hear your question, Janice?
do we have a policy discussion on the agenda today
With regard to...
with regard to bank loan, a bank loan policy
Again, I'm really confused,
presentation?
Janice. We go to the same meetings, we had this conversation at another board meeting. We had a conversation with the law department who's not here today, and for everyone's benefit, the issue revolves around the bank loan presentation, and the bank loan presentation has three parts to it. One is the IPS, two is the adoption of managers, and three would be the policy itself, and the tweak in terms of where we are with high yield versus the bank loans. So what Janice is referring to is a belief that the IPS should be in public session, and we're all for that and would agree with her on that. And it's the same thing we did in NYSERS. I think the context we had, and the law department was at the NYSERS meeting, and they're not here today, I'm sure, otherwise they would speak for themselves. And we had this conversation with the law department. I know Janice had it separately, I believe with the law department also, that it was appropriate because of the context of the conversation and the multiple aspects of it, to at least begin the conversation in executive session, and then when we got to the point where we would want to adopt the policy, that would be in public session. So as we did at NYSERS, we would go in and out of public session. So what I would say that this board should operate the same way that we did with the advice from the law department and as we did in NYSERS. So essentially, we'll start the conversation, and when we get to the point where we want to adopt the IPS, we'll go in and out of public session. Nothing here is inconsistent with what occurred in NYSERS or was inconsistent with the advice given by the board's attorney or the law department. So if that pleases the board, I think we have a motion to go in executive session, and I know that was second? Second. So I think we're in executive session.
Okay.
Okay, let's take a couple of minutes to break down the cameras.
But they have to stick around. They have to stick around. Go back in a little later.
Okay, should we keep them out?
So I think we need a motion to go back into public session.
We have a motion, is that the motion?
That's the motion.
Okay, we have a second.
Thank you. So the recommended policy for the investment policy statement for leveraged loans starts on page 12 on the bottom of our PowerPoint. It's in the 340s of your book. And the policy statement that we crafted came from, in addition to talking to the consultants, came from the language that we have presently in the investment policy statements in the investment policy statement for asset classes that are non-alternative, such as the U.S. and non-U.S. equity markets, the Core Plus 5, in fact, high yield. The high yield policy statement, in fact, was a major part of how we built this policy statement up. While we do have alternative policy statements, we felt that the alternative policy statements, such as for opportunistic fixed income, for hedge funds, for private equity and real estate, were different materially enough that we felt that the existing policy statement style for public markets was appropriate for bank loans or leveraged loans. Are there any comments?
I actually have a question for Barry, but it seems that he's left.
Here it comes.
Oh, here he comes.
Just in time.
Yes.
So we're talking about the high-yield investment policy statement? So my question is, in terms of SIS's thinking, are bank loans a subsector of high yield?
A cousin, more than a subsector, yes.
Cousin? So should they then have their own standalone policy, or should they be a percentage of our high yield allocation?
I don't think you should have an asset class allocation that falls below 3%. You're just
Never mind convertible bonds.
right, and I don't mind them. So I think it's appropriate to combine them.
Okay.
I would be reluctant to put fixed weights on the combination, like 70%, 30% high yield, 30, because the bank loan market has shrunk relative to the high yield market very considerably in the last 3 years, and you want to sort of keep a market cap perspective. What's happening is the issuers see these low rates for high yields and they want to lock them in, so they're issuing high yield debt to pay off the bank loans. You know, I think before 2007, the bank loan market was actually bigger than
It was over $1 trillion. It was pushing $1.5 trillion.
And today it's, what,
Below $1 trillion.
two-thirds of the high yield market. So those are, that's happened very quickly. I don't think you want to put something like that in a policy where they can change. But I think the statement that I made, that the issuers are substituting fixed rate debt for their floating rate debt today, says they're very close in terms of what your exposure is. I think they're an attractive component to the non-investment grade portfolio, especially today, because they are floating rate.
So do you agree with the 1/3 of high yield, or are you saying we should be more flexible?
I agree with, there is flexibility. It's up to 1/3. It's not fixed at 1/3. And that's what I like about it.
Okay, so it's 0 to 33%.
Yes.
I'm sorry.
0 to 33%. And should there be a target in there, or are we just saying that there should be a range?
A lot of this is parking place money, so it could come down rather fast. So I'm comfortable the way it is. If you wanted to pick a target, I would take the midpoint of the range. At least that will last you for a couple of years. You wouldn't have to change it every month.
And then, just in terms of what I know BAM has recommended to some of their other clients, do you have any thoughts in terms of a maximum to niche manager allocation?
Well, I like the 40-40-20. I am not really comfortable with the label of niche versus core because they're all very, very close.
Yeah.
And I would think if we find that Guggenheim continues to shoot the lights out, we would want to equal weight them with the other two managers. So I wouldn't want to put myself in that box. It's not like value and growth, where you really define things. It's a very nebulous label, or set of labels.
So Martin, you need the board to adopt the IPS?
So I had some comments on the IPS. I thought we were in the comment period. So are we adopting this today? Because
As we have with the other boards, it's our effort to try, most of the other boards, it's our effort to adopt the IPS today, yes.
Oh, because I had submitted comments to BAM and I don't see that any of them were incorporated.
that was for another board, and our recommendation is for this policy statement to be adopted.
Right, my comments were for the IPS, which is basically the same that you've presented for all the boards.
Right, and we feel that what we presented, starting on the in our PowerPoint on the bottom of page 12, is appropriate for leverage loan or bank loan investment policy.
And this board, for what it's worth, this policy was adopted at two other boards.
It was adopted at teachers, actually it was adopted at teachers and at fire.
As written here.
As written here.
Correct.
So I'd like to make a motion that we adopt the IPS as outlined by Mr. Gantz.
Well, yeah, I think that I'd like everybody to have time to comment on the IPS, and my comments weren't included, so I'm just...
I think I have a motion on the floor to adopt the IPS as provided by the Comptroller's Office. And I think it has a second, Mr. Chairman. Chair, excuse me.
We have a second by the DEA. Do we have all in favor?
Well, I'm not prepared to vote based on Janice's
So I think we should have a roll call vote then.
All right, can you give me a minute to call this one?
Sure.
Speak to Janice.
On the video, or do you want to keep it like a... You're fast. This is timeout.
Is that out of that count? Is that out of count?
To adopt the IPS as provided.
And it was seconded by the DEA, so before the vote, I'd like to open it to discussion. Janice, would you like to make
I
comments?
would. I would just like to express my concern that the board was not provided with adequate time to review and well, I guess we were provided with time to review and comment, but that the comments are not being accepted for some reason, which is inconsistent with how we've approached policy changes since I've been on this board. I don't understand the reason for it. I have a great deal of concern because our main role as board members is to set policy. It is one of the most important things that we do. And so I'm extremely disappointed and concerned that this policy, that the board has not been able to comment or provide suggestions.
I appreciate your concerns, but I think when you look at the totality of the record, that this is a policy that our consultant, SIS, is in favor of. It's been crafted by BAM. Additionally, it's been adopted by the, at this point, the majority of the other boards. So I don't know that we're all being consistent. Your comments were with respect to another board, and each board operates separately. So I fail to see how there's any inconsistency. And with that, I'd like to call the question, Madam Chair.
Well, I just have one thought. Are you aware of the comments that Janice has made? You said she made these comments in reference to a different board. You are aware of the comments?
We are aware, and they were made in another board, and we feel that working with our consultant, Mr. Dennis, that the IPS as constructed for police is completely appropriate and consistent with past practice that has occurred at this board, as well as some other boards. So, again, I think we should have a vote and move on. People should,
well, then we'll do
unless anyone else wants
vote.
to be heard, of course.
Is there any other comments anyone would like to make on this topic? Okay, then you do roll call then?
Okay, we're going to take a roll call vote on whether the board is going to adopt the investment policy statement for leveraged loans. PBA?
Yes.
DEA?
Yes.
SBA?
Yes.
LBA?
Yes.
CEA?
Yes.
Controller?
Yes.
Finance?
Against?
Mayor?
Against?
Police Commissioner?
No.
Okay, it's so moved.
Thank you.
Thank you very much.
There
are still two other pieces.
We're going to go back now to executive session, so we need a motion.
into executive session, so...
So we need a motion, Madam.